All right, let's get right into it. Today, in this explainer, we are completely decoding the high-performance financial engine that is driving CrowdStrike's massive market momentum lately. We're going to look at their latest earnings data, financial filings, and some independent market research to see exactly how this cloud-native cybersecurity giant turns lines of code into billions, yes, billions, in recurring revenue. If you've been wondering what's actually happening under the hood of one of the most talked-about tech companies right now, you are definitely in the right place.
Okay, here's our game plan for today. We've got 5 main areas to cover. 1, the AI infrastructure inflection point. 2, decoding the revenue engine. 3, the platform advantage. 4, profitability and cash flow. And 5, their future outlook and guidance.
Starting right off with Section 1, the AI infrastructure inflection point.
So, to really grasp the financials we're about to dive into, we have to talk about a fundamental shift happening in the industry right now. Because honestly, you can't appreciate the scale of the revenue without understanding the sheer scale of the problem they're solving. I want you to think about this question. What actually happens when cybersecurity transitions from being just a defensive necessity, a basic box you check for compliance, to literal, foundational AI infrastructure? Analysts are calling this a mythos moment for CrowdStrike. We are at this critical inflection point where securing your data and your cloud isn't just IT maintenance anymore. It is the absolute prerequisite for deploying artificial intelligence in the enterprise. That is the massive scale of the business we're dealing with today.
And this setup right here, this perfectly illustrates the fuel for their whole engine. CrowdStrike's agentic security platform architecture. Just look at the contrast on the left side. No hardware, no data silos, no friction. Legacy security systems usually need this messy patchwork of different agents that just bog down computers and leave all these dangerous blind spots. But CrowdStrike flipped the script. They use a single, incredibly lightweight AI-native sensor, that red core right in the middle, which then powers 32 distinct security modules. It's wild. This unified approach makes their product ecosystem incredibly sticky. Once a customer installs that one single sensor, turning on a new module is literally just a software update. It's not some agonizing months-long deployment. And the urgency driving all this adoption is summed up perfectly by CrowdStrike's CTO, Ilya Zaitsev. He recently put it like this: adversaries don't wait for posture reports to be generated and actioned. They are weaponizing frontier AI models to move from vulnerability discovery to exploitation near instantaneously. I mean, really think about that for a second. The bad guys are already using AI to automate their attacks. You simply cannot fight an AI speed attack with a manual human speed defense. It doesn't work. And that's exactly why we're seeing enterprises rushing to adopt this real-time point of execution protection right now.
All right, moving on to Section 2, let's decode the revenue engine.
Now that we've got the technological backdrop, let's look at how all that product adoption actually translates into top-line growth. And for that, we're zooming in on one key metric, ARR, or annual recurring revenue. If you follow cloud software at all, you know this is the absolute gold standard metric. ARR is simply the annualized value of all active customer subscription contracts. We care about this way more than simple one-off sales, because it shows us the predictable, compounding revenue that builds the baseline for future growth. It doesn't just tell us who bought yesterday. It tells us who is locked in and committed to paying for the next year.
And when you chart out that ARR, wow, the velocity is just stunning. In Q3 of fiscal year 26, they hit $4.92 billion. By the end of Q4, that jumped to $5.25 billion. That means in Q4 alone, they added over $330 million in net new ARR. And looking ahead to Q2 of fiscal 27, they're expecting to hit right around $5.79 billion. So we're not just talking about regular growth here, we're talking about incredibly consistent sequential expansion at a massive scale.
Which brings us to Section 3, the platform advantage. So you might be wondering, what exactly justifies all this rapid customer spending? Like, why are enterprises opening their wallets and throwing billions in recurring revenue at CrowdStrike? Well, look at this one single number, 264%. According to a commissioned total economic impact study by Forrester Consulting, that is the 3-year return on investment an organization achieved by deploying CrowdStrike Falcon Cloud Security. So it's not just a protective measure for them, it's an economic multiplier.
Let's break down how Forrester actually got to that incredible ROI. By bringing posture management and runtime protection together onto that single platform we looked at earlier, organizations are seeing a payback period of under 6 months. Less than 6 months, and from there, it generates $13.8 million in quantified benefits over 3 years. Because the platform consolidates all those clunky legacy tools and stops really expensive breaches right at the point of execution, the software essentially pays for itself. I mean, when you can save a company almost 14 million bucks, selling them a multi-million-dollar subscription gets a whole lot easier, right?
Okay, let's get into the financials. Section 4, Profitability and Cash Flow.
So the revenue is skyrocketing, and the product obviously has a huge ROI for customers. But we have to look at how that actually translates to the bottom line. Are they turning that massive $5.25 billion revenue base into actual profit? When you read CrowdStrike's earnings reports, you're going to see two sets of numbers, GAAP and non-GAAP. Let's clear this accounting gap up quickly. GAAP includes non-cash expenses, and the big one here is stock-based compensation for employees. Non-GAAP strips those right out. Why do we care? Well, in Q4, their GAAP net income was a modest $38.7 million. But their non-GAAP net income? A whopping $289.1 million. Looking at the non-GAAP metrics helps us see the true day-to-day cash-generating power of the business without the distortion of those non-cash employee stock grants.
And the real magic here is how all this converts to actual cash. Take a look down at the bottom right corner. Even back in Q3, they were generating $296 million in free cash flow. That represents a 24% margin. Let that sink in. For every single dollar of revenue coming in the door, 24 cents was turning into pure, unencumbered cash. That right there is the incredible leverage of a highly successful SaaS model.
And that momentum? It just accelerated. In Q4, they pulled in a record $376.4 million in free cash flow, which brought their total for the full fiscal year 26 to a massive $1.24 billion. So this engine isn't just growing the top line, it is brutally efficient at turning a massive chunk of that revenue into hard cash. They actually ended the year sitting on over $5.2 billion in cash and cash equivalents. Talk about a fortress balance sheet.
All right, final stop. Section 5, Future Outlook and Guidance.
So, let's see how management expects this to play out in fiscal year 27. Spoiler alert, they've significantly raised their guidance based on a record pipeline. They are projecting total revenue to push right up against the $6 billion mark, somewhere between $591 and $595 billion. ARR is projected to blast past the $6.5 billion threshold, landing between $653 and $655 billion. And that non-GAAP net income we talked about, they expect that to grow to over $1.26 billion. So yeah, the data clearly shows management expects this crazy momentum to keep pushing forward aggressively.
Now, quick aside for anyone actually building out financial models. AlphaSense reports highlighted some crucial housekeeping items directly from management. First up, they've got a 4-for-1 stock split coming up, so keep that in mind for your per-share metrics. Second, watch the seasonality. Free cash flow is expected to be weighted about 46% in the first half of the year and 54% in the second half. Net new ARR is looking similar, around 42% in the first half, 58% in the second. Just some vital, objective insights to help anyone mapping out the quarter-by-quarter cadence.
So, there we have it. We've decoded the engine, we've seen the foundational shift to AI, the insane ARR velocity, the platform's massive ROI, and of course, that incredible cash generation. Which really leaves us with one final, provocative thought. As their total addressable market just keeps expanding across cloud, security, identity protection, and AI infrastructure, can CrowdStrike actually sustain this kind of financial velocity in the years to come? Or is there a natural ceiling to their growth in this AI era? It is an absolutely fascinating question and one we are for sure going to keep our eyes on. Thanks so much for hanging out with me for this deep dive. I hope this explainer helped bring all these numbers to life for you. Keep learning, and I'll catch you in the next one.